Good morning. It's the last day of the week. You survived another week of the semester. That's good. First of all, you all saw the homework on Moodle, right? The company information homework, which is due next Tuesday. So basically, there is an assigned company for each one of you, and the list is on the Moodle as well. And from that list, you will figure out which company's information you will collect. And I talked to a couple of you, and I think it takes like 15 minutes, 30 minutes to do the homework. It shouldn't take more than that. You can use any finance web page. Write down your references, though. So I will know where you found the information from. I forgot to ask the stock price, so write down the stock price under the market information, because it says date of the, what was the date of the stock price? Okay, so one thing is date of the stock price. So I asked this because I wanted to know which day you wrote down the stock price for. And another thing, I assigned you one reading about Alibaba, which was also on Moodle, and I also put like an animated page about Alibaba as well on Moodle. Did you read it? Really? How many of you read it? Honestly? It's not bad. It's good. Okay, that's good. That's good. No, I'm happy with it. Now you're gonna have a quiz about it now. Okay. I thought about it, but then I thought it would be really cruel. Maybe I should do that. Okay. So hopefully today in the first hour we're gonna finish the introductory chapter, and then we're gonna finish the we're gonna start the accounting chapter in the second hour. And as you know, next Friday we don't have a class due to the feast. Okay. So what we did in the previous class was we talk about different stakeholders in the company. We talk about firms in the society, and we assume that managerial decisions have no social costs, and even if they do, it can be traced to the firm. So firms pay for the damage they create to the environment, let's say, in an ideal world. But then we said it's not the case in real world, but what we can do is, if you're not happy with a company's social actions, let's say, we can boycott them as consumers, or we can boycott them as investors. So we can stop buying from those companies, their products, or we can stop buying the stocks of those companies. And another thing we talk about was financial markets. In an ideal world, we assume that markets are efficient. All the prices reflect the true value. But in real world, it's not the case. People are acting irrationally. Investors might overreact to some kind of announcement. So we might have all kinds of problems with the markets as well. But what we can say is now the markets are getting more and more efficient. The US market is probably the most efficient one because it's one of the oldest ones. But Turkey is also is trying to make the market as efficient as possible, because efficiency means no bubbles. So everybody knowing all kinds of information, transparency, managers revealing information, correct information, and on time, they're delivering them on time. So all kinds of things. Then we talk about principal agent problems. Can you give me an example of a principal agent problem? Principal agent problems. Wake up, wake up. Principal agent problems in the company setting or in the real world. Okay, yes.
And the house owners and the real estate.
Thank you. The house owner is a principal, and the agent, real estate agent, is an agent. And in this setting, there might be agency problems, principal-agent problems. What was the problem in that example? Yes?
We, as a house owner, want to sell the house at the highest price.
Uh-huh.
But real estate want to sell it as
Quickly as possible. Exactly. So as a house owner, I want to sell the house at the highest price possible, which is kind of in line with what real estate agent may want because they're getting a commission. But at the same time, for me, I can wait. 1 week, 2 weeks, 1 month, 2 months, whatever, I can wait. But real estate agents, they don't want to wait because every week they wait, they have to put additional effort. They have to show the house to people, which is at least 2-3 hours, put advertisements, take pictures, put it on the websites, lots of things going on. So in this case, it is the easiest and very, very simple to understand example. Now take it to the company setting. Think about the stakeholders. Yes?
I was thinking about stockholders and managers.
Perfect. Stockholders and managers.
With the golden parachutes.
Let's go step by step. Who is the principal in that example? Stockholders or shareholders are the principals, and they are hiring CEOs because we have the voting right actually. We're kind of hiring the CEOs to manage the company. CEOs are the agents. Tell me about conflicts of interest between managers and a stockholder. Easy examples are also fine. It doesn't have to be very like financial setting. What you can think of as, yes, conflict. Sorry? We're going to go into that later. Very good. Debt holders and stockholders is another principal agent problem. But now, for now, let's focus on stockholders and managers. So what do stockholders want? They want, what do they want from the company, from the manager? Huh? We're not using that word in this class. Maximizing value, right? They want their value, their wealth, stockholder wealth, to increase, which means increase stock price. You all remember it. Not the P word. No. We're talking about the other thing, stockholder wealth maximization, which is stock price maximization. How about managers? What do they want? What they may want? What may they want? Maybe they want to play golf. They don't want to deal with the firm. Maybe they want to take the private jets, go to Alps and ski, you know, like maybe they don't want to work. Actually, interesting example, we covered in my other class actually. One of the CEOs, I don't remember, Tyco, maybe the CEO of Tyco, that guy threw a party for his wife, his second wife actually. I mean, divorced and remarried. Second wife, he spent, do you remember how much he spent? We talk about it. It's like almost $500,000 or something like that. And he used the company money for that party. It was extravagant. If you search for it, if you look at the pictures, there are like ice sculptures everywhere. It was in a private island, you know, and he used the company money. I think he's in jail now. So this is a conflict. Actually, there is an academic paper from a Harvard or Yale guy, I don't remember the name. He showed that managers using the private planes of the companies, their companies values less than the other firms. So it's all about trying to link those perks, like private planes, to the value. And some papers show that the more perks CEOs use, the less value they create for the shareholders, which is bad. So it's a conflict of interest. So what else can you think of? Oh, empire building. Like the CEO is going crazy with mergers. He wants to buy all the companies around because he wants to manage a big company. Big company doesn't necessarily mean a valuable company. So if you make stupid mergers, takeovers, then you're decreasing the value of your company. You're getting bigger, but you're decreasing the value of your company actually. So that's another agency conflict. And we said, what can stockholders do to protect themselves? Actually, more and more companies are linking executive compensation, and you're going to search for that information in your homework. They're linking the executive compensation to the company value. They say, okay, here you have some options. It's a financial term, option. You have the stock options, and you can sell those options if you increase the stock price. So if the stock price increases, he can sell, the CEO can sell the options he has, and then he's going to make lots of money for himself. So this is what they're doing in general. I actually put one article on Twitter about a Google guy. That's very interesting because when you look at the salaries of CEOs, sometimes you're going to see $1 as the salary. $1 per year for the CEO salary. When the crisis happened, lots of CEOs said in 2008, they said, okay, we're not going to get salaries. We're gonna reduce our salary to $1. And people were, oh, they're so nice. They're getting, they don't want to get, normally they get what, $1 to $5 million a year. No, what they're doing is they have lots of stock options, like a chunk of stock options. Maybe you're going to see in one of those companies as well. And their worth is very high. And if the stock price increases, they're going to exercise them anyway. And after the crisis, of course, you're at the bottom. Of course, stock price will go up after a huge, right? If there's a huge crisis, then of course things will get better after that. So yeah, executive compensation is one way. Another way is mergers and takeovers. If a CEO is not doing well, another company might be interested in his company. And it's actually a control mechanism for stockholders as well. But we said CEOs also know that, and they put anti-takeover devices in their companies. So their companies cannot be taken over, or even if they can be taken over, the value of the company will go down really a lot. That's why nobody will be interested in buying their companies. Or sometimes they are buying their seat in the new company at the expense of stockholders. So the moral of the story, CEOs know more than we do, so they're doing their best to protect themselves. One thing you said was golden parachutes. Like if CEO is not doing well, what are you going to do? You can fire them. But since they have golden parachutes, in the Pfizer example, the Pfizer guy left with what, $200 million? So it's legal. They put the golden parachutes in their contract. And even if they are not doing very well, even if they are fired, they get some money, which is good for them, bad for stockholders, of course. Then we talk about debt holders and stockholders, as you said. And in this example, who is the principal, who is the agent? That was kind of confusing. Debt holders were principals. And it was as if the debt holders are giving money to managers / shareholders. And shareholders are agents in that example. What's a conflict of interest between those two guys, debt holders and stockholders?
Stockholders may want to risky.
Yes. Investments. No, you're doing very well.
Investment, but debt holder don't want the risky investment. They want their money as quickly as possible.
Exactly. Shareholders don't care that much about risk. Why? Because they have limited liability. They cannot lose more than they spend for the stock. And the price they paid for the stock is a sunk cost anyway. So after that point, they can, if the stock price becomes, I don't know, $1 million, then they're going to enjoy the benefit. Debt holders, on the other hand, they want to get their money back. They want to get the capital plus interest. So they don't want the CEO to make risky investments. They want safety. They want cash in the company. So can you think of like a cash example distributed to stockholders that might be bad for debt holders? Yes, dividends, for instance. Stockholders want dividends. It's additional money. But debt holders might say, yeah, maybe you shouldn't pay dividends and keep the money in the company so that you can pay me when the time comes. So that's another thing. So these are a couple of agency conflict example between debt holders and stockholders. And what can debt holders do to protect themselves from those conflicts? Huh?
They can do restrictions in the contract.
They can put restrictions on the contract, covenants, if you remember. Actually, we are going to have a workshop on 24th of October, finance workshop. We have guests from Koç University, Sabancı University, Özyeğin University, Middle East Technical University. And actually, we have a covenant session in the afternoon at 1:30. I'm gonna inform you about the time. So if you're interested, you can come. Aysun from Sabancı and I will talk about covenants in the afternoon at 1:30. So if you want to hear more about covenants, of course we will present academic papers, but it's still very easy to understand. So if you don't have anything to do, you should come. It will be fun. Anyway, debt holders can use covenants. And those covenants put some restrictions. They say you cannot spend more than $500,000. That's it. So a covenant can say that. A covenant can say can put dividend restrictions. They can put leverage debt restrictions. It can say you cannot have additional debt. So that's one way for debt holders to protect themselves. Okay, so it was like a little summary, which took 15 minutes. Now we can move into the new stuff. We don't have much left. So basically, we talk about all of those things. So let's just move on. We know all the problems in the market, all the problems with the agents. There are more. We didn't, of course, cover all of them. But you have an idea what kind of conflicts we might experience in the real world. But what do? In this class and in academia, we start our assumption with the basics, which is interests of shareholders, debt holders, managers. They're all aligned. They're all the same. And we say that we try to concentrate on optimal decisions, and we basically focus on value maximization, which will translate into stock price maximization. Okay? So know about the problems, but don't get too excited about, let's say, know about the problems, because when you go into real world, you're going to experience these. So if you become a CEO, you're going to know what kind of things you can do to get value from your shareholders. But of course, do the best for your shareholders. Okay, now a couple of very simple things. What the firms look like. So I'm going to put a hypothetical organizational chart, which will be different for every company almost. But you know there's a board of directors. These are the big guys. They sit there to monitor the CEO. Okay? And then you have a CEO. He might be the chairman of the board as well, the head of the board. And then you might have a president. President is generally the president of the board of directors. So the definitions sometimes change. As I said earlier, this is different for every company. But the president might be the chairman of the board as well. But generally, presidents are, like if you think about Turkey, presidents are the big owners. In Turkey, most of the businesses are family owned. Like I think 70% of the companies are family owned. And the president is generally the elder guy in the family. So he wants to, there's nothing wrong with that. They are wiser. So they're generally the president of the company as well. And then we have the vice presidents, CFOs. In our case, CFOs are important because we are finance people. There's chief of marketing as well, if you are a marketing person. And there are treasurers and controllers. Treasurers, they deal with the money, cash inflows, cash outflows, everything. And then you might have here cash managers, credit manager, capital expenditure, financial planning. Then the controller They control everything. So they deal with the taxing stuff, cost accounting, financial accounting, data processing. So very simple firm. This is a very simple form. What happens is investors invest money in the company. Financial managers decide about how to use that money through firm's operations. Real assets are bought, factories, I don't know, whatever, plants, whatever. Real assets, okay, cash raised, okay. And then real assets are formed, and then financial manager decides how this cash will be distributed to investors again. So the same, the first chart I've ever shown you is revisited here. This is what the financial manager does. He decides about every financial decision in the company. And let's just try to figure out the difference between treasurer and controller. Very simple example. We have Ayşe and Fatma. They graduated from Bilkent University Faculty of Management 10 years ago. They want to become financial managers. Ayşe studied finance with an emphasis on financial markets and institutions. Fatma majored in accounting and became a CPA 5 years ago. Who should be the treasurer? Who should be the controller? Let's ask you. Yes, Fatma will be the controller. She knows all the accounting, all the entries and stuff. And Ayşe will be a treasurer in that example. Very simple. Ayşe, Fatma. Careers in finance. In the last year, probably you're going to deal more about those. These numbers are from US, of course. So basically, if you have a regular job, you start with $60,000. This is gross amount, annual amount. So $60,000 a year, 30% of it is tax, let's say. So you're left with $40,000 a year. Divided by 12, 43. Okay, so $3,000 or so is your salary as an average college graduate. And if you're in the, I don't know, the best one is, of course, going into hedge funds or investment banks. But basically, to be able to go there, generally they want PhDs if you want to go up. And generally, you see math, physics, PhD students there. Because it's all about modeling and data processing, actually. They also take finance PhDs as well. But your starting salary is $250,000. And if you this is nothing as a hedge fund head, because they get additional money as well. So if you're interested, you should go into hedge fund. But I remember I had a student, very smart girl. She was like Turkish, actually, Turkish American. She found a job in an investment bank. Everything is in Chicago. She's one of those girls, like she can get anything she wants. You know, she knows what she wants and she can get what she wants. I saw her after a year and she was like, I hated it. It was like a boys' club. I hated to be there as a female. Like, it happens in the US as well, okay? Gender equality. Yeah, it's not that equal in the US as well. It's a tough world. You have to be really greedy and lie very smoothly, let's say, and deal with people very easily. But I'm talking, you watched, what? Wolf, no, what was the, yeah, what, it was a disgusting movie. Yes, yeah, you probably saw. Wolf of Wall Street, yeah, it was. Wolf, and then there was Wolf of Wall Street. Yes, exactly. Yeah, so you saw it. And I heard it's not that inaccurate, actually. No. Okay, now we talk about almost everything. Now focus on financial markets part. Then you will have a very good sense of idea about what finance is about. Then we will go into details later. Okay, I put the Apple example here, and we're going to talk about Alibaba if we have time at the end of the lecture. You know about Apple, right? Yeah. I talk about Apple a lot. Maybe we should get like a sponsorship from Apple, right? Okay, So Apple, who started Apple? Did you see the Apple movie? I didn't, so probably you know more. So we have the Steve Jobs, and then there's this other guy. Huh, yeah, I can't tell the surname. Steve something guy. Okay, and they started Apple. So if you have any additional information, just jump in, okay? Any like fun stories from the movie, just you can jump in. Okay, Apple started in 1976 in the basement of Steve Jobs' family. I think that was correct, with $250,000. So it's a startup company, it's a technology company. In the first couple of years, he was able to raise $3.5 million from venture capitalists. So basically private investors, okay? And then in 1980, they decided to do their first IPO. I mean, IPO has to be first anyway. It's initial public offering. So it was a private firm. Then they decided to go public. And we talk about why companies do that. Why companies do that? Why do companies do that? Actually, to find cash, to find money, to find capital. And yeah, increase liquidity. So in 1980, they did their first IPO. They raised $91 million compared to $3.5 million from angel investors. It's pretty good money, right? Till 1987, they didn't do any dividend payments, which is okay because growth companies don't do dividend payments. Why? They need to cash for investments. They're growing. They have to do investment. Then they 1994, they issued $3 million debt. They needed more money, okay? And they issued all that debt. In 1996, 1997, they had a loss of $740 million. They had to they suspended dividends, which is really bad for companies. If there's a company paying dividends, and then all of a sudden, if they stop, of course, you're going to say, oh, red flag, something wrong is happening. The company is in trouble. So they were in trouble, actually. And they restructured their debt. They sold their existing debt with new terms. In 2004, Apple paid off all of its debt, like Turkey, paying all of our debt to IMF. Apple paid off its debt, and there was no long-term debt outstanding. So maybe in your example, in your companies, you will find a few which doesn't have any debt. Okay, and from 2005 to 2010, again, no dividend payment. And in 2010, actually, I updated it, but I forgot to save. Okay, I remember anyway. In 2014, their retained earnings. What is retained earnings? Do you remember what retained earnings was? Think about net income. Part of net income was paid out as dividends, and the rest was retained earnings. So if I remember correctly, they have $90 billion retained earnings in the company. Do I remember correctly? No?
Yeah.
Okay. And their debt structure, if I remember correctly, they have 20% debt now. But in 2010, they didn't have any debt. Now they have 20% debt. Is having debt a bad thing? In general, cost what? Sorry? It actually may. Yeah, you're right. So if a company is going under debt, it's not necessarily a bad thing. Actually, there's tax advantages of that. What is tax advantage of that? Think about the income statement. You start with revenues, right? Revenue minus expenses minus depreciation. Then you pay interest if you have debts, which will reduce your taxable income, right? If you have less taxable income, you pay less money to government. So there's a tax shield of debt. And actually, it makes cost of debt smaller than cost of equity. So debt is not a bad thing. But if you have a lot of debt, no. If you have a lot of debt, then what's going to happen to the interest rates for you? If you add debt all the time, then the banks will increase the cost of debt for you because they're going to say, you might be in trouble, your bankruptcy probability is increasing, so it might be a problem. So this is the story of Apple. Thanks everyone. Okay, now let's talk about the terminology. Okay, so what is a financial market? You know the story of Apple now. Basically, financial market is a market where financial assets are traded. And we have primary and secondary markets. We don't have this label, primary market. No, it's just a definition we use. And all the issuance of new securities happen in the primary market. In general, we ask those kind of questions in the exam. Primary market, secondary, yes, this is kind of important here. Exam, yes. Okay, so whenever a new security is issued, it has to happen in the primary market. Like public offerings. We talk about Apple. Initial public offering. It's a new security, right? It didn't exist before, the security. But Apple issued securities, and it's sold in the primary market. When a stock is issued, when it is sold from the company to the public, money is raised. What happens? To be able to buy that stock, you pay money to the company. So the company raises money. So from the company to the public. Seasoned equity offering, SEO, seasoned equity offering, is the second, third, fourth, fifth, sixth time, whatever, the company issues stocks. So initial public offering is the first time. Initial, a private company going public is initial public offering, but then you can issue more stocks to raise money. And it happens with seasoned equity offerings. And this also happens in the primary markets. Why? Again, it's a new security being traded. A fresh security is being traded. Fırından ekmek alıyorsunuz gibi. Primary market. You might have private placements. It doesn't have to be public. If a company is selling ownership to private people, like 2-3 investors, it also happens in the primary market. Again, primary market is an imaginary place. Okay, it's just a label we put for those kind of transactions. It is also a primary market action. In the secondary markets, it's trades of previously issued securities. Apple issued stocks, somebody buys it, Ali buys it. It happens in the primary market. Then Ali sells his stock to Ayşe. It happens in the secondary market. In the secondary market operations, do I, as Apple, get anything from transaction? No, I don't get any cash whatsoever. Then why is it good for the economy? Why is it good to have secondary markets?
It increases the volume of the market.
Exactly. It provides liquidity. There are investments going on all the time. And huge investments are going on all the time. Liquidity is a good thing. You heard about New York Stock Exchange? It starts with the bell. Somebody rings the bell, it starts. It's kind of an auction market. New York Stock Exchange or American Stock Exchange. These are auction markets. What it means is, in the auction markets, somebody says, I want to buy, you see all of those Wall Street movies. There are people raising hands in like crazy atmosphere. It's New York Stock Exchange. And literally, there are people trying to sell their stocks. There are people who are trying to buy stocks. And they're matched through auctions. So it's all about, oh, I want to buy this. Oh, I want to sell this. This is my price. This is my price. Okay, it's a match. And of course, New York Stock Exchange or NASDAQ, these are businesses. You know, they are also like companies. They went public. I think both of them. In 2006, New York Stock Exchange went public. So these are companies as well. It's businesses. They are getting fees. There are annual fees. There is starting fees. Those companies get from other companies. So companies pick which stock exchange they're going to be listed. Do you remember Alibaba example? They decided to go listed in NASDAQ or New York Stock Exchange? Do you remember? New York Stock Exchange. I remember New York Stock Exchange. NASDAQ is an over-the-counter market. It's a dealer market, actually. Everything is happening electronically. So you don't see those crazy people running around in NASDAQ. In NASDAQ, you generally see high-tech companies, growth companies in NASDAQ. In New York Stock Exchange, you see more mature and established companies. And also, annual fees are higher in New York Stock Exchange. In NASDAQ, it's smaller. Alibaba, it's kind of a tech company. It's not really tech, but it's kind of a tech company. But they decided to be listed in New York Stock Exchange for different reasons. Okay, so these are the different markets. If you want to trade debt securities, bonds, bank loans, whatever, it happens in the fixed income markets. Debt securities are called fixed income. Why? Think about bank loan. There's fixed interest payments. Bonds, we're going to talk about those later. They also have fixed payments. So all the debt security transactions happens in the fixed income market. And you already know that whenever a company raises money, debt holders get paid first, then shareholders. So they have senior claim on cash flow. And if you remember, if a company cannot pay off its debts, it's going to be bankruptcy. So it's a huge deal. That's why the debt holders get money first. Equity securities, we talk about those. They can be common stock or preferred stock. They're the second, third guys in the line to get money from the company. But they're the owners of the firm. They control the company, or they're supposedly controlling the company. There are other markets as well. There's foreign exchange markets, commodities markets. I just learned that. I knew there's like a wheat markets, buğday, alım satım, I knew. But I just heard that there's a market for eggs as well. I didn't know that. It's very strange. So there are also, I'm not talking about like pazar kind of market. I'm talking about like price determination kind of a market. So there are options markets, whatever. And the last thing here is the difference between capital market and money markets. Capital market is for financial assets which have longer maturities, like a 2-year financial asset will be traded in the capital market. If you have a shorter term asset, financial asset, it's traded in the money market. As I said, like you don't see, oh, here is money market kind of thing. It's just the definition we're using to have an idea about what those markets are about. Any questions? Okay. Then let's talk about the financial intermediaries, which are very important for an economy. It is very important that they are well functioning, because if they don't, you probably remember the banking crisis in Turkey. Like, I don't know, it wasn't very long ago, in the beginning of the century. When financial institutions are in trouble, the entire economy is in trouble, because they are the ones that are running the money, basically. And for those, we have a couple of examples. We have mutual funds. Did you hear about mutual funds before? So basically, as investors, we can log in and we can look at all the different stocks and we can pick which ones to buy. Or you can send a check to a mutual fund, or you can have a mutual fund manager meeting, and you can say, okay, here's my money. Please use that money, make the investment for me, and I will give you a fee for that. So they pick the stocks and all the assets for you. And you pay a fee for that.
An example of
There's Vanguard Mutual Fund in US, for instance, but its name is generally something mutual fund. But I couldn't think of any Turkish companies. Let me think about it. Maybe in the break I will find one. Okay, so basically they diversify for you. So as an individual investors, you can pick 5, 6 stocks, whatever. They can pick 20, 30 for you. And when they diversify, they're reducing your risk actually. When you have more stocks, or they also pick bonds, they pick global stocks as well, not just Turkish market. So they diversify for you. Hedge funds are the big guys. As individual investors, they wouldn't even take us seriously. So here they're spending either $50,000, $100,000, more than that. They're also doing the same thing mutual funds are doing, but actually these are taking very risky investments. That's why I said in the Wall Street you see physics, math guy. They are doing modeling. They're taking really risky investments, and when they make money, they actually deserve it. They're making tons of money, and their life is really very tough. I know a couple of them. It's crazy because they are managing other people's money, and they have to be on top of the game all the time. So they are also picking investments for you, for big guys. And then pension funds, we all know those. Basically, part of your money is put in a pension fund when you get your salary. And the company you work for basically use your money to make investments. And when you retire, you get money from the pension fund. Bilkent has a pension fund, for instance. Then we have other financial institutions. You all know about commercial banks, you know, Akbank, Garanti. We have insurance companies, Aksigorta. Okay. We have investment banks. Investment banks are different than normal banks. They actually give advising and consulting services. You cannot go get a loan from an investment bank. You might have savings and loan companies, brokerages, whatever. So basically, all those institutions are like financial intermediaries between investors and capital users, capital providers and capital users. So what kind of purpose they serve? As I said, they're really, really important. One, with financial markets, you can transport cash through time. Put your money in the bank. If you don't want to spend now, take it 5 years later, spend it when you want it, with some interest. So it's money traveling, basically. Payment mechanisms are easier. Everybody uses credit cards. They write, you write checks. You don't carry cash with you all the time, which is good. Facilitates borrowing and lending. It's good for liquidity purposes. If I don't want to spend now, I put it in the bank. Someone who wants to make an investment goes to the bank, takes the money, and do the investment. This is also very important, pooling risk, reducing risk, basically. So they do diversification for you. Like the mutual fund example, they pick 50 stocks for you. Diversification is a good thing. And the same with insurance companies. So how come insurance companies don't lose money? So if you think about fire insurance. So you have fire insurance. When there's a fire, you are getting ridiculous amount of money from insurance companies. How come insurance companies can survive? Yes?
Because you pay insurance every month, but you got a fire like once in your life or twice.
Exactly. Since there is, the probability of one person having a fire in the next 5 years is, I don't know, there's some probability assigned to it. But since they're having lots of different people, they're kind of doing the diversification as well, and they're getting all those fees. So the probability, they work on probabilities and math and everything, and they pool risk. Same with casinos. They're pooling risk, right? When you win big, but it's all about probability and statistics. So They always win. Insurance companies, they always win. It's how the system works. This is the last slide I want to talk about. And the last couple of things is about financial crisis. This is a very nice animated video. I think it's 5 minutes or so. I'm not going to show it here, but watch it if you still have trouble understanding what happened in US in 2008. But I'm not going to talk about it here. Okay, the last thing is cost of capital. This is important. Just give me a few minutes and then I will let you go. I mean, not go, but break. So basically, cost of capital, sermaye maliyeti, is the minimum acceptable rate of return for you. Kabul edeceğiniz minimum getiri oranı. What does it mean? So suppose that you have an idea about the cost of capital of an investment. It's 10%. You're going to find money from a bank with 10%. It's your cost of capital, and you will only use that. If you think that this project's return is less than 10%, would you take the project? No. So the cost of capital is your minimum acceptable rate of return on a project. So in some sense, return and cost goes hand in hand, right? Minimum acceptable rate of return is your cost of capital. You're trying to make more return compared to what money you have to pay for the project. Okay? The simplest example, you fund the money from the bank at 10%. If you think you're going to get 20% from that investment, then you go for the investment. If your return is less than 10%, if it is 5%, it's a bad investment. It's less than your cost of capital. And one more thing, equally risky investments should have the same return, because we believe that return is determined only by risk. So if there are two stocks, two companies with the same risk, their return should be the same to you. Any questions? Then let's take a break.